Hi, guys, and welcome to the Quinn podcast. Here we give you a look through the eyes of the most successful athletes, entertainers, entrepreneurs, and influencers on this planet. Be sure to check out all of the content at quinnpodcast.com. Enjoy the episode. Times probably, but after university, you went into real estate. I saw you worked a couple jobs in the sector. Sort of take me through the initial phases of your real estate journey.
Yeah, so I graduated from undergrad when I was 20 years old with my degree in finance. And, I went into the corporate world and started in real estate and was working for some of the largest companies in the world. And it was great until 2012. And that was the year that my husband and I got married. And he also was a W-2 high income earner. And we lived in DC at the time. And I remember we paid taxes as a married couple for the first time because before that we were both paying
Mm-hmm.
single, right? And so we paid taxes as a married couple. And I remember calling my mom and being like, Mom, we just paid like $200,000 on taxes. And she's like, Well, first of all, congratulations, because that means you did really well if you had to pay more in taxes. But she said, also, you should quit your job. And I was like, What? I work for like a multi-billion-dollar real estate firm, like private equity firm.
Right.
He was like, Yeah, but the IRS does not reward you for being an employee. They reward you for being a real estate investor or an entrepreneur or a business owner where you're creating wealth for the economy. And so I said, okay. And I quit my job at one of the largest real estate firms in the world and ended up starting to invest for myself and started investing with single family. Quickly realized that that is not a scalable venture and ended up in multifamily. And
Mm-hmm.
fast forward to 10 years, or actually, it's been 13 years since I quit my job. And now I've done over $1 billion in multifamily transactions, and I bought multiple businesses, started multiple businesses, and kind of like a serial entrepreneur.
No, that's amazing. Did you see yourself doing that, like the entrepreneurship part,
No.
when you were like a kid or in high school? There wasn't a thing for you, no?
Okay. I've always been an entrepreneur ever since I was a kid. Like, I
Sure.
just had that spirit in me. I started a gumball business when I was like 3, and I would sell gumballs to people that happened to cross my path when I was 3 years old, right? And so that was like my first foray into business.
Right.
And then, as I got older, I started doing things like babysitting. And then one of my friends and I started this little party planning company that did not do well. It was more of a
Mm-hmm.
failed venture, if you will. Um, but yeah, I've always had the entrepreneurial streak, but I always thought that when I got older, I wanted to have a family and be a mom, and I wanted to prioritize staying home with my kids in the same way that my mom did. But what I didn't realize when I was young is that she was doing more work than I even realized. Just being a mom in and of itself is more work than you could ever realize.
Sure.
But then two, she also was a real estate investor. And so she stayed home with us, quote unquote, but she was also generating income and tax savings for our family and building wealth for our family. So
Mm-hmm.
she was doing that through real estate investing. So I never really thought that I would go out and run businesses. I thought I'd like, have a property here or there. And that's exactly how I started, was with that intention. And then realized that I loved it and felt more ambitious than that. And there was something more to be had. So that's how I continued growing. But I had no idea I would do all this. I thought
No,
I was
sure.
going to just have like a quiet suburban life with 2.5 kids and a white picket fence.
Right. Didn't really work out that way, and I got you.
No, no, not at all.
I got you. So at the point your mom told you you should quit your job, right? Did you feel like you were ready for that step in that sense? Like, okay, I'm gonna go out on my own. I'm gonna start these businesses. Um, how did you see yourself as like a business
That's a good.
woman in that sense?
Um, I think I've always kind of looked at major decisions not from like the upside, but more from protecting the downside.
Mm-hmm.
So I think when my mom said that, I was like, okay, what's the worst that happens, right? Like, we could put food on the table because my husband was still working. we didn't have kids to worry about, so the stakes were relatively low. And so I was like, all right, if I quit and it doesn't work, then I could just go get another job. I can apply for another job. I
Hmm.
still have my degree, I still have my experience, my resume, and my network. And so I was like, okay, the worst is I just get another job and go. I end up right back where I am now. Whereas if I
Sure.
don't try this, then I might get stuck where I am. And that felt scarier to me, as being in the same place that wasn't serving me in the best way that it could, versus taking the risk and failing at it and then having to start over or pivot. That felt like a better risk than
Hmm.
the one of staying the same.
Gotcha, gotcha. So take me sort of through the initial like months or years of like
Yeah.
that
Okay.
decision.
Yeah. So I quit my job. I put in my 2 weeks notice, and then my manager was like, "Hey, we're in the middle of like our big audits for the year," which we were, which is also part of why I was like, "This is the perfect time to quit because I don't want to do the audits. This is boring work. It's mindless work. Here's
Right.
my 2 weeks." And then my manager was like, "We, this is going to put me in a really bad spot. Can you stay for an extra 2 weeks?" So they asked me to give a month's notice instead. At the time, I was like, "Oh, I really don't want to." But I did, because I firmly believe that whenever you can bank a favor or goodwill from
Hmm.
somebody else, you should. And I'm
Sure.
glad I did. So I updated my HR letter, and I said, based upon so and so's request, I have agreed to extend my, time here by another 2 weeks as a courtesy to the company, because now I know it's in my HR letter there. And if I ever wanted to get rehired, I was rehirable.
Hmm.
I thought they would like look favorably. It didn't even matter because I never went back and applied for
Gotcha.
another job ever again. Um, but yeah, so I quit, and actually the first like 6 weeks, I didn't do much of anything. I was like, "Oh, maybe I'll be like a stay-at-home wife now, and I'll brunch and shop." And like how the movies portray like these kept women. I was like, "Oh, maybe this is what I'll do." And I would like clean and make dinner every night and be very domestic. And after about 6 weeks, I quickly realized that this was not going to be a long-term thing. I was bored so fast.
Mm.
I was 26 years old, so I didn't have a lot of friends that were in the same position as me to be able to go and shop for 6 hours on a random Tuesday, right? And so it got boring really quickly, and it wasn't fulfilling. There's only so much you can brunch and shop, right? So then I started looking for real estate, and I was kind of dabbling in it, but I wasn't taking it very seriously. After the first 6 weeks of the novelty wearing off, I started looking pretty actively for properties that we could acquire. And about maybe it was about 2 months after that, I found our first property. I put it under contract. I did everything we needed to close on it. We actually still own it to this day. And then that was my first deal that I did outside of our primary home.
Hmm.
And then after I kind of got that and understood that, I've continued building on it. So that was 13 years ago now. And
Hmm.
that deal I bought, I paid $255,000 for it. And at the time, that felt like so much money. And I mean, it is still a lot of money, don't get me
Sure.
wrong. But at the time, I was like so scared of it. I was like, oh my gosh, this is the most money I've spent on an investment. I was so nervous. And then fast forward to today, $255,000 wouldn't even hit my radar of a deal we would look at,
Hmm.
because, I closed in 23, I closed $131 million deals. So needless to say, there's been a lot of growth in those years. But it was a stepping stone into what I do today.
Did that feeling sort of skill like does like the 225 you mentioned like that made you nervous initially? How does that work? Like branching your horizons in that sense.
Yeah, I was nervous. But once you do it, right, you're proving to yourself that you can do it. You're building that
Right.
confidence. So then I was like, oh, wait, I could do this again. I've already done it once. And so
Mm.
then I went out and I did it again, bought another home, and I continued on that path. And then there was a week where I bought five. Like I put five under contract all in the same week.
Hmm.
And then I was like, wait a second. Even if I find five deals every single week that I want to do, I can't ever own 10,000 doors like that. It would take me forever to get to scale. And so that was when I realized I needed to get into the multifamily space because it gave me the ability to buy 100 doors at a time
Hmm.
or 500 doors at a time. And that was the path I saw to scale. And I loved residential real estate because I like the idea of revitalizing someone's home and providing a place for someone to live and, creating that safety for them. That was something that felt meaningful to me.
Hmm.
And so multifamily was like the perfect bridge between residential and the scale of commercial. So I
Right.
got both the aspects I was looking for, and that's why I ended up in multifamily.
Got you there. Did it feel like looking back now on you like in that era, um, you felt like you feel like you were knowledgeable back then, or you were like extremely naive about the whole
No,
thing looking back?
yeah, no. I mean, honestly, the more I do deals, the more I realize I don't know.
Right.
It's like as I get more experience and
What
knowledgeable.
was like the biggest thing for you, like looking back, that you were like, oh, this is so stupid that there was a way to make decisions or something?
Actually, you know what it was? I wish when I look back, I'm like, why did I feel like I had to start playing small? I listened to
Mm,
what everybody else said about it
right.
instead of going straight into multifamily, which I
Hmm.
could have done. I didn't know I could. I didn't
Right.
know that people like you and I could own multifamily. I thought you had to be like a Vanderbilt or a Rockefeller to be able to own multifamily assets or like Oprah.
Hmm.
So that was like the biggest shock for me is wait, I can own this. I don't have billions of dollars. At
Hmm.
that time, I didn't even have millions of dollars, right? And
Sure.
so I was like, I don't think that this is real, but it was. And I was like, wow, why don't they teach you this? I did a whole degree in finance. I took so many real estate courses,
Hmm.
and nobody told me about this ever.
So tell me about it, because that's a paradigm I'm holding right now.
Yeah. So what people don't realize is a lot of these assets, especially the 5 to 150 doors that are
Hmm.
being bought and sold every day, are owned by regular people. Like they're owned by people like you and I. And what they do is, and this is what I do at Five Funds, is we bring together groups of investors. So let's say um, there are 10 investors that each have $100,000. They put
Hmm.
it all in, and then we take that pooled money, that $1 million, and we go out and we buy a $2.5 million building and we operate it. And then let's say we sell it for 5 million
Hmm.
5 years later, right? So we've doubled our money. We take that money and then we go out and we do it again and we take that 5 million and we roll it into a $10 million asset. And then we take that 10 million and we roll it into a $20 million asset. And that's how the snowball really grows. And that's the power of investing over long periods of time, is being able to really scale and build generational wealth.
Got you there. Interesting. What do you feel like? What's because you had no experience, right? That's interesting to me. Like going into I imagine even back then it was crazy competitive to acquire those properties.
Yeah. Yeah. So no experience in multifamily, yes, but I had enough pedigree and I had enough on my resume that I could translate the experience, right?
Hmm.
So, like, I had my degree in finance. I had worked at some of the largest real estate companies in the entire world.
Hmm.
I had relationships that were deep in institutional avenues. So for me to be able to translate that and then say like, okay, now I also have all this single family experience. So I had the institutional knowledge background, I had the formal finance training, and then I had the entrepreneurial experience of single family.
Hmm.
So I had all the different facets. I just didn't have them in one deal per se.
Hmm.
And so when I was able to take that and then translate that into larger scale projects, that's when I was really able to understand how to scale up. And then once you do your first multifamily, it gets a lot easier to do bigger deals and continue growing your multifamily that way.
Gotcha. Take me through. Okay, so you're starting multifamily. Then take me to the point that you're actually owning a fund, because I imagine there's years of work condensed there.
Yeah. So reaching way back into the archive of my brain, right? When I first started buying multifamily. My first deal was in Dallas. It was 200 doors. We were buying it for $15.9 million. And the way I got into that was I had a friend who was in the space. I met him at one of, the networking events that happen, the REIAs or whatever.
Mm-hmm.
And he called me up and he was like, "Hey, Veena, I have a deal under contract. It's 200 units in Dallas, and I happen to live in Dallas." And he said, "Do you want to partner on it?" And I was like, 200 doors, my first multifamily deal. What could possibly go wrong? Those are famous last words.
Right.
Literally everything. But what I will say is we were able to take that deal. We bought it for 15.9 million. Within 15 months, we refinanced the deal and we were able to give investors back 40% of their capital, their initial capital.
Mm-hmm.
And then about 2 years after that point, we sold the deal and we sold it for just over $24 million. And that basically set me up for continuing to grow and scale because once you're bitten by the bug, it's really hard to escape it and get away from it.
Mm-hmm.
And so then I did, my next deal. And I did so many deals within the course of just a couple of years that were successful and continued to snowball and grow. And then fast forward to these last few years. And like I said, in 2023, we had the largest all woman led transaction in the entire country for multifamily assets. And that was a $131.5 million purchase.
That's amazing. So that's sort of the peak there in
Yes.
investing, and then you start a fund. Take me through that. How does that work?
Yeah. So we actually started our fund. You're talking about our multi-asset fund?
I guess.
Yeah. Okay. So most of our deals, it's like a single deal, right? So I have one,
Mm-hmm.
two, three Main Street apartments. I come to you. I say, "Quentin, do you want to invest in this? It's 123 Main Street. This is the business plan. This is the address. You can go walk it. And then you can say, "Oh, no, I hate this asset. I love this asset. I live next door to it," whatever, right?
Mm-hmm.
So that is one type of investment, and that was the first one, and that was the one I have done the most of in my
Mm-hmm.
career. And that's because investors typically, like retail investors, like to know that they are investing in a specific asset. They don't necessarily want a blind fund or a semi-blind fund
Mm-hmm.
until you have experience and a track record. So once I had enough experience and a track record, back in 2021, we launched our $100 million equity fund. And it's a semi-blind multi-asset fund, meaning that we tell investors we're going to buy multifamily assets. This is generally what it's going to look like. This is our buy box. Do you want to invest? But they don't know that it's 123 Main Street apartments necessarily. They don't necessarily know what the actual target is going to be because we don't know it when we launch the fund.
Mm-hmm.
And so we launched that fund, and investors now can come in and have a more diverse position across multiple assets to protect further from any downside risk.
Mm-hmm.
And so we've been running that since 2021. I think there's four or five assets remaining in the fund. And so each underlying asset, we also own and operate that. So the fund actually, we invest into the assets that we control.
Got you there. So yeah, okay. I'm trying to wrap my head around it. It's an interesting space though, for sure. So what like yield are you shooting for then? How do I sort of see that?
Yeah, so it depends on where we are in the market cycle and obviously type of asset. For our assets, historically, 5 years ago and longer, I mean, for us to get an 18 to 20% return was not unusual. In 2022, I sold an asset that got my investors a 50% IRR, meaning we basically doubled their money in 18 months. It was an insane deal. Now in today's environment, today's market, the market's changed. We're not in a bull run anymore. We're definitely in a bear market. And I would say now, if you're getting anywhere in the double digits for IRR, That's
Hmm.
pretty solid. These are all risk adjusted returns, right? So if I'm projecting out a 12% IRR, it's going to be a lower risk deal than if I'm showing a 17% IRR, for example. So I would say in today's market, if you're getting anywhere from 12 to 15%, that's probably like a pretty stabilized value add type deal, very vanilla,
Hmm.
not exciting. It's should be very boring, very steady. I'd say that's really where the market is today, but that changes all the time.
What time frame is that? That's per year or how do?
Per year, yeah, annualized. So
Okay.
IRR, your internal rate of return. So basically, it's like a time value of money based calculation to
Hmm.
determine what your level of return is from a pure like APR or interest rate perspective. We're looking anywhere from 13 to 16% annualized.
That's pretty amazing. That's
So
pretty
yeah,
amazing.
and they're tax efficient. So that 13 to 16% is actually like getting 15 to 18% in the stock market.
Hmm. Got you there. Actually, like this is interesting to me. Like actually launching like a fund to have like people invest in.
Yeah.
How does that work? Maybe more from like a. I'm in law school. Maybe from more from like a
Oh,
legal perspective.
yeah.
Like
Okay. Okay. Yeah, I love the legal side of it. I'm the partner that handles all of our legal and
okay.
tax compliance. I work with our attorneys and professionals often. Okay. So all of what we do falls under securities law. So when you are looking to raise capital, and this is true whether you're raising capital for a business, for a like a tech startup, whether it's real estate, doesn't matter. You in the US, you are going to be under the purview of the Securities and Exchange Commission or the SEC.
Hmm.
So when you have the thought, I want to raise capital, the very second thought you have is, I need a securities attorney, not any attorney, not a transactional attorney, not a real estate attorney, specifically a securities attorney. And the reason I say that is because the rules are very stringent. And what you'll hear from a lot of educators or a lot of like these like real estate gurus, right, is, oh, we have a loophole to the securities rules. No, you don't. You do not have a loophole. There is no loophole. Trust me, I know. I've been in this game for a long time. I have talked to our attorneys ad nauseum about this. There isn't a loophole to the broker dealer rule, which is usually the most common violation that I see. What the broker dealer rule says is you cannot be paid transaction based or success based compensation for raising capital. In other words, I can't come to you and say, hey, if you have a friend that'll invest $1 million in my project, I'll give you 3% of their investment as a finder's fee or a referral fee. Or unless you're a registered broker dealer, then you can get paid because you are actually licensed to do this and registered to do this. That's totally fine. Most people are not registered broker dealers. So, what you'll see a lot of people say is, oh, there's a loophole. And I'll go, okay, what's the loophole? And they'll go, instead of giving you 3%, I'm going to give you 5% of the equity in the deal. And it's like, no, it says transaction based or success based compensation.
Hmm.
That means that if the payment is contingent on your investor investing in my deal and making an investment decision, then that means that you cannot receive any compensation for that.
Hmm.
If it is not based on that, then you can receive compensation. But then we get into this like whole muddy water and it has to be done very correctly. So, highly recommend you reach out to a securities attorney. We use Nick McGrew out of Polymath Legal based in LA. His Instagram is Nick the Lawyer, NIC the Lawyer. He does a lot of education around this too. So if you're looking to raise capital, I cannot stress enough how important it is to have the right lawyer on it, because when you are raising capital for deals that we do, right, you are selling a security. You meet the Howey test. There's four parts to the Howey test. If you meet all four, you're selling securities. So we meet all four. We're selling securities. The nice thing that the SEC has done is they have included certain exemptions that if you're doing certain things and you fall under certain guidelines, you do not have to register the security. And so you still have to tell them you're doing it. You still have to tell the SEC that this is an unregistered security that we're going to be selling, but you don't have to actually go through the formal process of registration. So you can rely on that exemption.
Hmm.
Now, depending on how you want to raise capital, who you're raising capital from, all sorts of things, you may choose exemption, the Reg A, you might choose the Reg D, you might choose the Reg CF. It depends on your deal and what your needs are to be able to select that, and your attorney will help you do that. And then based on that, there are certain rules and regulations you're going to have to follow. So, like, for example, if you choose a Reg CF exemption, you have to use a FINRA approved portal to manage your investor accounts, and the SEC requires it. So you have to go and find those portals. You can't just go and find some random app from the shady person down the street that made it. But on a Reg D, we don't have that requirement. We can use any portal we want, but there's certain rules around advertising, or a Reg A restricts how much money you can raise from each individual investor. Reg CF has those limitations. So anyway, all this to say, there are many rules and regulations. That's why there's a whole entire practice of law
Sure.
and a subspecialty of law dedicated to this. And so you need a securities attorney. We fall very deeply under securities rules when we're raising capital.
Gotcha there. The actual capital raising, like how do you approach that? Is that mostly from your network? Is that
Yeah.
the speakings you do? Take me through that.
The answer is yes, all of the above. When you first start out and you're first raising capital, almost always it is going to be what we call like a friends and family raise.
Hmm.
More likely than not, the people that are going to invest are going to be the people somewhere in your network, not necessarily your closest friends and family, but that second layer, the PTA friends that you hang out with, the neighbors that you do block parties with every quarter or whatever. Those are more likely going to be the people that are going to invest in your deals
Hmm.
because you don't have a track record yet. And
Sure.
so once you establish a track record, then you can start going out and raising from accredited investors that maybe don't know you. And that's where, speaking gigs, social media, promotional events, marketing, all of that then converts better because now you have a track record that you can point to.
Again, back to the sort of the competitive side of things. How did you sort of look at that? Like, okay, there are so many funds out there. There are so many, whatever. How did you differentiate yourself?
How did I? Well, it's kind of easy when you are not a white man in private equity.
Right.
I think inherently I stood out because there's not many women in this space. There's not many minorities in this space. So I think I inherently stood out. But I think when you start out, if you don't have experience, you have to make up for it in knowledge, right? So you have to be able to understand and be able to explain both at a complex and at a very simple level what you're trying to do, right? And
Hmm.
so they say when you have true mastery of a subject, you can explain it to a 5-year old.
Hmm.
So that was something I worked on a lot, was understanding the concepts, reading about it, learning, and just being a sponge and absorbing as much as I could and building a really big network. As you progress and you get the experience, right? Then your experience can make up what you lack in knowledge because you've done it so many times, right? Like
Hmm.
they're very, well, I say this and knowing that there's probably a million more I haven't seen yet, but there's very few surprises or things that are going to surprise me when we're going into a new deal because I've seen so many versions and iterations.
Hmm.
But the more important thing is now I'm trained to expect the unexpected. And now I'm trained to be able, I have enough knowledge and tools to be able to problem solve around it. Whereas when you start out, you don't know what your options are to problem solve it because you just don't have enough data. You don't have enough um, you don't have enough trial experiments or
Hmm.
trial runs to know if I pull this lever here, it's likely going to do this, this, or this. What am I trying to accomplish?
Right. So how do you communicate that? Because me, as a white man, I feel like I'm at a disadvantage. Yeah.
I don't think you're.
That
I
was a
don't think
joke.
you're a disadvantage. I feel
That
like
was a joke.
Yes, it's not going to be as easy
Okay.
to walk into a room and stand out. But the opposite is also true, right? Like as a white man in this space, you are going to be presumed to have more experience and
Mm,
qualifications and credibility than you probably deserve when you first start out, right?
sure.
Whereas for women in the space and minorities in the space, it's the exact opposite. Even today, when I'm in rooms with less seasoned operators, less experienced operators, if they don't know me or I haven't told them who I am or what I do, then they discount me and they assume that I'm like the admin or I am a analyst or something that's like a um lower level job title than where
Hmm.
the job title actually is, right? And so you will have the presumption of competence no matter
Right.
what, right? Whereas the rest of us don't get that. But here's the way that we've really stood out from our competition, especially as it stands now. One thing that I think we do really, really, really well is communicate to our investors. We really pride ourselves on white glove service. And if our investors have communication from us, I can control how often that is, right? But if they have
Hmm.
communication from us, that builds trust and confidence and partnership. So our investors, if something is going wrong, they hear from us. If something's going right, they hear from us. If there is a negative potential outcome, they hear from us more. So deliver good news fast and bad news faster. That's like
Hmm.
the motto that we've set. We also try to do everything with excellence. We're really good about accepting feedback and constructive criticism and then trying to recalibrate and adjust. I have a JV partner. Her name is Ellie Perlman of Blue Lake Capital. She's incredibly smart and she is really good with process and she's very process and systems driven. So she comes in and implements like really great standardization across both of our companies to help us keep everything streamlined. And that way everybody kind of knows what to expect. And so that has been a secret weapon that I don't possess on my own. I'm not a systems and process person. I need people around me to execute on that vision. For
Hmm.
me, I'm like the solutionist in our partnership, right? Like, so when we have capital stack challenges or legal issues or compliance issues that we need to resolve or we need to think about before we go into a deal, that's where I do really well and shine is like when there's creative thinking to be had. So it's kind of like a yin and yang.
Hmm.
So what I would say is identify what your strengths are, lean really far into them, and then whatever weaknesses you have, find a really great partner that can partner up with you and can provide those weaknesses or those areas that you lack.
Gotcha. That's big. What's the at your scale right now? What's sort of the biggest challenge for you that you're facing?
Oh, the same that it's always been is mindset, right? It's
Okay.
when you start out, it's mindset. When you scale, it's mindset. When you get to the next level, it's mindset because every new level that you're trying to get to, you have to conquer the mindset of the person that needs to show up. And you've never done it before. So you have to work on the mindset first
Hmm.
before you can actually show up as a person who's done $1 billion in transactions. Like, if you would have asked me when I first started investing in real estate if I would ever buy, forget $100 million deal. If you would have asked me if I ever would have bought a $10 million deal or a $5 million deal, I would have been like, no, I'm buying $250,000 houses, $500,000 houses. I'm not going to buy a deal that's 10 times the size of this because I couldn't fathom it. I couldn't imagine it. And that's why I think managing your mindset, like I always tell people, this 6 inches of real estate between your ears, that's the hardest real estate you'll ever manage. And if you don't manage it, it's going to manage the rest of your portfolio too. So it's doing the deep inner work and that mindset work, and I still do it today. So I my mindset coach Rosie Noel, I've been working with her for 2.5 years now consistently. And when I first started working with her, I would work with her 5 days a week every morning, Monday through Friday. I
Hmm.
would start my day with coaching with her. Now she has like other clients, blah blah blah, whatever. I hate it. um but now I try to get her at least 2 to 3 times a week.
Hmm.
because when I can have my mindset correct, then I can show up as a better leader, a better CEO, a better entrepreneur, a better mom, a better wife, a better friend, a better daughter, all these things, sister. I have all these roles and I show up as a better version of each of those roles when I am doing active mindset management.
What does that look like? Like, how have you felt sort of difference in your day to day from that?
Yeah, so one, I have learned to detach emotion from some of the decision making processes that we have, which was hard for me because a lot of my identity and my self worth is wrapped up in our real estate deals, or was. And it's been intentional and active work for me recently to decouple those two things. Both exist, but they are not codependent on each other. So the way my mindset coaching works and what I like to focus around, and this is one of Rosie's specialties, is there's an assessment called the Clifton Strengths Assessment. Hands down, the best personality assessment ever. And I know everyone has like their own one that they like, right? Like Myers Briggs or DISC or whatever.
Hmm.
And I've taken all of them. The Clifton Strengths is the best one. It's a Gallup backed assessment, and Gallup is like a multi-billion-dollar research firm. So it is actually scientifically backed too. It wasn't just like made up by a person. And what Gallup says is there is a world of 34 different talents that all of us have innately inside of us, and they're stack ranked. So it's not that you have weaknesses, it's just they're your lesser strengths and they don't come forward often. But anybody can do anything, regardless of what your strengths say, the orders say. It's just a matter of how you approach problems. So, like, for example, I am number one competition, I am number two communication, and I'm number three woo, which is like winning others over. So I care a lot about creating relationships and like building friendships, and I want to get to know people, and I'm an extreme extrovert, so it all fits for me, right? But competition is my number one. Now it's always there. It's always on. And when I wasn't actively managing it, my competition would show up in negative ways, meaning I would compete with my partners, with the people on my team. And it wasn't until I started working with Rosie diligently that she would be able to point out when my competition was coming out in negative ways. And she'd be like, wait, why are you competing against this person? This is your teammate. And I'm like, she's like, let's reframe the definition of winning for you. So you still feel good about it, but now you're reframing what your focus is. So now instead of, competing against someone on my team, I'm like, hey, let's work together so that we can win together. And I still get the satisfaction of the win that I inherently need, but also now is working toward a better and a common goal. So the Clifton Strengths is, and also the other thing that's nice about it is once you take it, it's like a 20-minute assessment, but once you take it, you don't have to take it again after 19 years old. It doesn't really change unless there's like some kind of major trauma or major life-changing incident, but you can basically keep the same assessment for the rest of your life, and the more time you spend in it, the more powerful it becomes. So I did mine back in 2018, and I have been deep diving into it over the last 2.5 years, and it has completely changed my life.
It's amazing.
Yeah.
Yeah, it's easy to lose sight of that part of basically the business, right?
Yes.
Um, because it's like there's so much going on that sort of feels like as priority, and then you're like, oh well, we'll see about that, and then these thoughts pop up. I'm like, I don't know, I should probably revisit that.
Totally.
Yeah, got you there. I like that. I'd love to touch on like the actual deal making itself. I think that's tangible. It's interesting.
Yeah.
What's sort of the difference between like initially like the $250,000 deals and
Yeah.
then the $100 million deals? Like, how do you show up differently? How do you prepare differently?
Yeah.
What are the
Mhm.
expectations at that level? Take me through that.
Yeah, I mean, I guess the biggest difference is there's a lot more zeros on the $100 million deal.
There you go.
The stakes are definitely higher. Believe it or not, it is counterintuitive, but it is easier for me to finance a $100 million deal than it is to finance a $250,000 deal. Because when you're financing single family at $250,000, your lender, your bank is looking at it as what can Veena do to make sure that we're protecting our investment? What is her credit score? What is her DTI? What is her income, right? Like they want to know everything about me. When a bank looks at $100 million deal, they care about Veena, right? They care about the experience. They care that I am knowledgeable and capable and whatever. But they really care more about what the business of the asset can do because it's actually underwritten like a business, not like a real estate asset. And so, can the $100 million asset produce enough income that this makes sense for us to lend on it and it's secure enough and they'll be able to pay it back? So, they don't underwrite it as a person buying an asset, they underwrite it as a company buying a business. The business just happens to be in real estate. So that's like one of the major differences. But what I will say is it's not all that different, like from a process standpoint. The major overarching steps in the process are pretty much the same.
Hmm.
So you have to target the deal. You have to underwrite the deal to make sure the numbers work. You have to make an offer. You have to negotiate the offer. You have to get under contract. You have to capitalize the deal. So either you're securing lending and equity, or you're securing lending and you're bringing your own equity. You have a partner, whatever, right? So you're getting your capital stack in order. You're completing your due diligence on the asset simultaneously. So you're looking to see, are all the systems, is what you think you're buying actually what you're buying, right? And then there might be a renegotiation if you're not. And then you get to closing, you close the deal, and then you start operating the deal. So, and then you exit at some point in the future or you refi. So, all of those steps are the same. Where you start differing, right, is on an offer for a single family home. You're doing it usually on a promulgated contract that the state provides, right? Like in Texas, where I live, we have TREC, the Texas Real Estate Commission, and they have a promulgated form that anybody can go and pull off their website and fill it out and use that as a widely accepted contract. When you're buying $100 million deal, it's not a 5-page contract that you print off of a website. We have attorneys involved. They negotiate back and forth. Our attorneys negotiate with lenders' attorneys. I have many times where I'm on a call with like 8 attorneys at the same time, and all I can think about is, okay, this is costing me $2,000 a minute. Say half as much as you need to say and talk twice as fast is like how I like to think about those meetings. But those are important because your attorneys are there to protect you, and they are there to, your transactional attorneys are the ones that hopefully can prevent you from getting to litigation attorneys. And the
Hmm.
more you can rely on your transaction attorneys, the better off it is in the long run, because litigation is expensive. No one wins except for the lawyers. No one walks out of there like, yes, that's a slam dunk. Usually it ends up settling where both parties aren't fully satisfied, but they're willing to walk away from it. Um, so there's lots of differences within the sub processes, but the overall process doesn't change a whole lot.
Gotcha there. What's your system for evaluating deals then?
So yeah, to get the valuation on a deal, we use back of the napkin math first, which there is like one formula. If you're going to be in multifamily, this is the formula to memorize. It is NOI, or your net operating income, divided by the asking price, your purchase price, fair market value, whatever you want to call it, and that equals your cap rate. So basically, what we're trying to do is determine, is this asset worth what we think it's worth? Your cap rate is what your yield is if you assume that there's no debt on the property. So
Hmm.
if I buy this $1 million property with $1 million in cash, what is my yield going to be? Like, what am I going to return? That's our cap rate, right? Our fair market value, we'll use our purchase price, right, to see, okay, we're going to pay $1.1 million. Is it worth it? Or, hey, we're getting it under contract for $750,000, but it's worth $1 million. Well, guess what? My cap rate goes up then if I'm paying less for it. So I'm getting a higher yield on those dollars because I'm underpaying for the asset. And the converse is true also. So when we buy an asset, we want to pay as little as possible. So we want the highest cap rate possible. When we exit a property, we want to have the highest purchase price possible, right? We want to sell it for the highest price we can. So we want the cap rate to be as compressed and as low as possible. So there's competing interests for buyers and sellers, and that's where the inefficiency is in the market. And we can come in and we can take a slice of that. But my back of the napkin math is just NOI divided by purchase price equals cap rate. Does that check out? If that checks out, then we move to a more robust back of the napkin or back of the envelope math where we put in a few variables and kind of see what it looks like. If that still passes the test, then our analysts will go in and deep dive and we'll start doing actual preliminary due diligence in the market, meaning we'll call competing assets and ask them like, hey, what's your rent, what's your occupancy, all the questions that we need to know to see how that market performs. We'll start secret shopping the asset. We'll start fine tuning our numbers and we'll do complete underwriting. That's our first passive underwriting. From the time we start targeting a deal to the time we exit a deal, so we close on it, we operate it, and then we exit it, we underwrite probably, oh gosh, dozens of times, if not 100 times, because we're constantly fine tuning our numbers because we get better data every week. We're getting better data, so we're re-upping it, and we look at our deals on a minimum of a quarterly basis, but usually about a monthly basis. We're looking at the underwriting to see, okay, because underwriting is a guess, right? Our pro forma is a guess of how the property is going to do. We won't know until Q2 2026 hits if we're going to be able to hit the things we think we're going to hit, right? It's an educated guess, but it's still a guess nonetheless. So what we do is in Q2 of 2026, we look at our underwriting and we go, okay, this is what we thought it was going to be. This was our pro forma, and this is our actual. How far off are we, right? And we do this on a weekly basis in general. But then we'll re-underwrite the deal based on what Q1 data shows us what we think Q2 can do. Or we'll rewrite based on what we actually did in Q2 for what we can do in Q3.
Interesting. Gotcha. Yeah, no, it's highly fascinating to me. Like the whole, there's so much depth there.
Yes.
Yeah, it's like I'm rediscovering like a whole, like
A
first day of
whole
law school.
world.
That's how
Yeah.
it feels like. Yeah, that's fun. What would you recommend for like I'm sort of at the beginning
Yeah.
stages of my career? What would you do if you were me? Like in a sense of start learning about this, and then let's say in a decade, starting to invest. Like what's important to do right now?
Well, I wouldn't wait a decade to invest. I would start
Okay,
right now,
gotcha.
right? Because time in the market is way more valuable than timing the market. And the time value of money tells us investing $1 today is more important than investing $2 tomorrow.
Mm-hmm.
So, no world I would tell anybody to wait to invest. It's invest and wait, not wait to invest, right? So one is don't wait for 10 years.
Gotcha.
Two is start gathering knowledge and education. There are a ton of free resources that you can access in a million different places. Recently, one of the areas that I have been mentoring a lot of people who want to either get into multifamily or want to scale to multifamily, one of the lowest hanging fruits is going into wholesaling multifamily. This is a really unique time, and we haven't really had this type of opportunity in my lifetime where owners need to fire sell assets. They just cannot sustain them.
Mm-hmm.
And multifamily assets the value is dropping. Owners are fire selling them. There are buyers now coming back into the market. So it's a really good time to get in and wholesale these assets. And from wholesaling a multifamily, you can make 5 or 6 figures from one deal. So you wholesale a deal or two or three, and now that builds you a little cushion that you can then take that and go and start buying assets and owning those, because that's where you build generational wealth. Wholesaling is like today's money, buying and owning assets is tomorrow's money. And so you need both, right? You need today money and you need tomorrow money. So you take today money and then you go and you buy the thing that's going to give you tomorrow money. So we've been talking a lot about wholesaling assets. I actually put together a masterclass on how you can get started doing this and like all the things you need to do day over day to get started in wholesaling multifamily. It's at learnfromveena.com. You can go, it's 2 hours. And it's not like a sales pitch or anything like that. It's like the technical data that you need to get started. And what's really exciting about it for me is we now can partner with more people. We can find more partners because I can only do so many deals, right? Like I only have so much volume that I can handle. So I need more partners, transactional partners who will work, and they'll either go find the deal and then we'll bring the money and we'll close the deal, or they will find the deal, close it, and then need an operating partner or whatever. And now we can come in, we can partner and collab, and that's how we grow our portfolio faster.
Hmm. Gotcha. Cool. Um, you mentioned your closing because I respect your time. You were at $250,000, and now you couldn't see yourself doing those $100 million deals, right?
Yeah.
What do you feel like is the thing you can see yourself doing right now that's like the moonshot for you?
Oh, oh, that's a good question.
Thank you.
That's a hard question because if I could see myself doing it, then I can verbalize it. I think where I'm going next, or where I'm trying to go next, is really more into a role of thought leadership around diversity and women in leadership. And so I guess, oh gosh, it feels so audacious to even say it, but
Do it.
what I would want to do is I want to be someone that can create spaces and communities of women who can then get into the private equity space. And I want to change the landscape of how it's always been done. I don't think that it's been done the best way or the right
Hmm.
way. And so I want to challenge systemic norms that we've live by, and I want to change it from a systemic perspective, not just for me and my family, but for everybody altogether. And so I guess that's the moonshot.
Thanks for listening to the Quinn podcast. If you enjoyed it, you can go to quinnpodcast.com to check out all of the previous episodes. quinnpodcast.com.